A key metric to tell how well the economy is doing is how much the consumer is spending. And the way the economists refer to this as is the velocity of money, how fast that money is moving from hand to hand. And that's why I came across an article that definitely brings a cause for concern. It talks about how so many Canadians have so much of their wealth and so much of their future income tied up into mortgage payments. So we'll be breaking down that article. We'll also be talking about if interest rates were to increase, what that would do to the current scenario that's going on. And we'll also be doing a cost breakdown. So we'll actually look at a physical example and we'll throw some numbers into a few calculators just to give you an idea as to what I am talking about. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. I have a huge favor, a huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I would definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. I would definitely appreciate that. The article that I was referring to is that more than 30% of Ontario homeowners can't afford much more than their mortgages. We've seen the flight of people leaving downtown cores to move to suburbia, get more land. This obviously had a lot of people going and buying instead of renting. And 3 in 10, 31% of Ontarians who own a home say they're house poor, meaning they don't have much more left over after paying bills related to their home. So we have 2 million homeowners in Ontario are susceptible to financial disruptions, such as an interest rate increase, which we will touch on in a bit. Perhaps not surprising that 2 in 10, 18% of homeowners say they regret the amount of debt they took on to buy their home. So we know that this has kind of been caused by people fleeing cities. It's also being caused by the low interest rates that we've seen for almost a decade now, record low at this moment. And it's definitely a huge cause for concern. We've touched on this topic many times before, and you can go and I'll link those videos up in the description for you. But I think the main thing to note from this article is that a large percentage of a person's income today is being put towards only the mortgage payments. And there's a couple theories and a couple theses, but if all your money is going towards your mortgage, effectively you become house poor. And if you become house poor and you need and you want to go do certain things like travel, vacation, restaurants, this either becomes you lose out on building an emergency fund, so you don't have as much capital if something were to go wrong with your home, or we start swiping these credit cards, and this leads to the credit economy, which is something that's definitely in play today. We definitely know that the Bank of Canada likes to run the same model, but going back to the guy that I look up to, Warren Buffett, you'll see who's swimming naked when the tide goes out. So when things go bad and you're levered up and you have a lot of credit, that's when the potential disaster will happen. And that's definitely the concern that I have. So we see, just to highlight this point, despite the concerns, 34% of Ontarians say they plan to spend more money on things like travel, dining, and entertainment in the months ahead as the economy reopens. So it's definitely a large percentage of people. So 30% there can't afford much more than their mortgages. Now let's talk a little bit about rising interest rates. So this is definitely the number one issue for the Canadian housing market. And let's talk a little bit about what will happen if the mortgage rate, so the rate that you pay on your mortgage, the interest rate, were to increase just 1.5%. This could double the monthly mortgage payment for some homeowners, double it. So right now, if you're already house poor, if you've already put a lot of money towards your mortgage, this is definitely a huge cause for concern. We know some mortgages are around the 1 to 3% mark, and the overnight bank rate is 0.25. So if they were to double this, the banks would obviously go and increase. So with that being said, let's just take a look and see what a specific example is. And one of the resources that I use is actually the Canadian government puts out a mortgage calculator. So if you're interested in checking this out, go check out the description. I'll throw the link here. And I'll use a particular example. Obviously, you can go in and run the numbers yourself, but the example that I'd like to pull out is maybe more of like a downtown core type scenario, single person. Obviously, we know people aren't getting married at the rates that they're getting at. And we'll take a look, and we'll go on the high side of interest rates right now, just to kind of help bring the point and kind of escalate. But you can definitely go in here and check out your own numbers. So we're going to pretend here that the house that was bought was $800,000. Now, the reason I have 640 in here is I've put a 20% deposit down. This will alleviate any CMHC insurance, which is definitely expensive. So if you want to go and factor that in, please do so. This example won't put that in. 255 is the mortgage rate. The expectation is that interest rates will need to increase from here to the short term. At what rate, at what discussion? We know Trudeau mentioned earlier this week that he does not consider monetary policy when he's making this decision. So in a future video, we'll talk a little bit about the different parties and their plans for housing and monetary policy. But let's just take into account that you lock in for 255 over the next 5 years. You hit this calculate button, and what you'll do is you'll get a calculation summary here. So you'll get an indication. Just a note here, I put biweekly payments on my mortgage. So the number of payments in this term, which is the 5 years, is 130. But the most important part is that I will be paying $1,300 bi-weekly. So $1,300, just to give you an example, you have this $1,300 is going to be, let's say on a monthly basis, which we should have done is 2,660. So $2,600 on the mortgage here. And then if you want to get more curious and get a better understanding, this site definitely helps you to see how much interest you will be paying over the lifespan of the mortgage. So you'll be paying about $224,000 on top of the $640 that you owe over that 25-year amortization period. So how long the mortgage is supposed to last. So that's something that's definitely been interesting for me to break down and check out these numbers. But we can take a look here, and now what we'll do, just to give you an example as to how much a particular person is paying. Another site here is talent.com. They have something called the income tax calculator in Ontario. I've put in the fact that somebody could be making $80,000, which is definitely maybe a respectable pay for me. You can come in here, hit the calculate button, and it'll tell you how much you're paying in taxes, how much your employer is paying in taxes. You can come in here to see what you're paying per month. So we know that our mortgage payment is $2,660, and our net pay on our monthly is $4,970. So what we'll do is we'll just take this and we'll divide it by $4,970. And we see here that 53% of my income today, without any increases in the interest rate, is going towards my mortgage payment. So you know that there's so many other things to consider. There's property tax, $3,000 to $4,000 per year, which is probably a couple $100 per year. You also have insurance, you have utilities, you have potentially condo fees. So this is definitely a concern. We've seen some countries in Latin America start to increase their interest rates. There's an election coming up. It's definitely important to see what the plans are for the federal government, if they have any, in terms of A, housing, and B, what they're going to do with the economy. with inflation in July hitting 3.7%, this is definitely where economists might say, hey, we need to, slow the brakes on how much money we're putting in terms of buying bonds. I know, the debt levels are extremely high. We might have to start increasing. If we increase these interest payments, what does this do to the market overall? So that's definitely, something that I'm watching right now. I'm not saying that it's going to capitulate. I'm not saying that the Canadian housing is going to fall, but if we don't have people putting money into the economy, if money's not circulating as fast, it will definitely slow down the economy and could lead to potential further damage, because there's not much more the government can do. The Bank of Canada, my apologies, can do to help stimulate. We can't put interest rates any lower, and we can't print out any more money because we'll just be further in debt more than we already are. One of the other things that I just quickly wanted to highlight is the fact that we can see this chart since 1980. We are putting it's basically the amount of salary versus how much home we're buying. So our salaries aren't increasing to the rate at which the home prices are buying. This is kind of leading all into the fact that we're becoming more and more house poor and forever indebted to our mortgage. So it just shows you, we used to be paying 3 times our salary in 1980. Now it's over 7 times. So it's definitely something needs to change. Hopefully it doesn't crumble. I know that's not what I wish, but there is some macroeconomics behind here that are definitely a cause for concern. But I hope you enjoyed the video. I hope you got some value out of it. There are more costs when it comes to buying homes, especially at these levels. I hope you're taking them into consideration. But I hope you all have a great week in the markets. Happy trading.